Ladies and gentlemen, welcome back to the Daily Capital Flows live stream. We have a lot of news coming out overnight on the biggest position I've been talking about and all the developments for that on the hyperliquid side, and specifically for the PER thesis that I've been laying out. And we are seeing hyperliquid bid on the day. We're also seeing Oracle bid on the day as well and make a bit of a new high right here in alignment with the macro view that I've been laying out. And the progression that we are seeing is just continuing to move in lockstep with the macro regime and the credit cycle that I've been laying out for a while now. And so if you are brand new to all of the different research that I'm putting out and all the work that I'm doing, and that myself and James is doing every single day, we've done streams every single day this week, 8:30 a.m. Mountain Standard Time, and we have been building a base of knowledge about macro and the asymmetric bets within that. And once you're able to do that, that sets the stage so that you actually have informed analysis when you have moves like today, where you begin to have more news come out and confirm the thesis that we've been talking about for a while. So I think we'll have a lot of interesting things to cover today. And then on the macro side, the main thing that we're going to cover is about this entire idea of the interest rate complex and how it connects to every aspect of where we are in the cycle right now. And I think that the idea that I've really wanted to focus on in today's session is we're going to cover what's taking place in the market, how it connects to equities, hyperliquid, the bets that I've been laying out. And then we're also going to connect and go over the entire interest rate complex, because I've published reports on this. I've talked about it a lot, but the main focus for macro is always understanding interest rates. If you can understand interest rates, you are beginning to contextualize every single other decision that you have to make or another market participant has to make. I think this is one of the biggest things is people might think that, oh, well, I don't feel like interest rates impact me. They impact the largest institutions in the world, which means buying and selling in any asset class is driven by the financing constraints that every institution experiences. And so we're going to be covering all that in today's live stream. James, thanks for hopping on. Any initial thoughts on just what we're seeing from overnight and what we're seeing with the new news on hyperliquid?
You're getting clarity. It looks like clarity is going to be going on all day. I think Elizabeth Warren has 44 amendments to the bill to work through because she's the devil. And we're going to hopefully work through that. And the Coinbase kind of teaming up with hyperliquid after going so long with not even ever acknowledging them, I think goes to show you how just the product and the vision and the penetration that hyperliquid has had is too big to ignore now, and Coinbase is effectively capitulating to that. So I think both of those things combined, you're seeing a kind of broad bid in the crypto space today. Whether or not that equals a sell the news type of event, we'll see. There's a big kind of moving average is trying to battle with right now. But as you know, I think both of us have a little bit of a bias, maybe a bit towards the upside, considering everything we've been talking about on the credit cycle expansion. So I have to say, I'm going to pat on the back here. This week has been pretty accurate, just pretty dialed, been able to think through everything that we've been seeing in markets, including the Tuesday breakdown, willingness to bid on Wednesday, and seeing some follow through here as we get some good news from the China summit. So everything looks good on my end. Excited to see some people out there seemingly feeling some good vibes today.
Yeah, I mean, I think that any days where we can see, Elizabeth Warren fall over when she's going on her walker, that's a good day, right? You can just see all this.
Well, let's wait till we get past all of her amendments and she doesn't ruin this entire party.
You're right.
She is going to fight tooth and nail.
We don't want to upset. We don't want to upset the elderly. We really need to be sensitive about
the Native American elderly.
The Native American elderly. Yes, right, please check yourself, James. Check yourself.
The Native American name for Elizabeth Warren is like woman with warrants or whatever, lots of amendments. Hi, I am
the old witch in the village that you're just like, probably stay away from her.
Yeah, who knows? So.
So I think this week we've covered several things. One is the entire interest rate side and macro side. And again, this goes back to the entire goal that we have over and over. And for Capital Flows, the mission and idea and goal is very simple. Map the macro regime so that you're on the right side of it, and find a very few large asymmetric bets that can take us home run trades. That's the entire goal. If you want to have exceptional returns, you start there. And so the ideas I've been laying out on the credit cycle are the starting point for where we are. And I laid this out yesterday in the stream. I talked about this entire thread that I did on the credit cycle melt up and the coming crash, how that functions. I'm going to retweet it right now. What I would encourage you to do is go through this thread. This sets the context. If you don't go through this thread and you're not reading the research on the Substack, you are going to hear the data points that we go over in this section, and you're not going to really understand the full implications of it because you don't have the context for what's taking place set in your mind. At the end of the day, the reason why you can see information that other people don't see, or the significance of information that other people don't see, is because you have a context that you have curated and developed over time, so that when you actually have information come out, you can correctly interpret it and have an edge in being able to know how to respond to it. And so this is the thread that I laid out on everything. And then again, everything for the research that I'm laying out, or you're saying, oh, I need to start mapping this with the models and things like that. All the educational primers laid out in the Substack right here, capitalflowsresearch.com. Go over everything on here. You can find all of the recent live streams. They're published every single day with all the slide decks. So the one that we went over yesterday, if you're trying to understand macro liquidity, this is the one that you want to watch. May 13th, that was yesterday. Go through the entire live stream. We explain how do you begin to think through liquidity and why it happens and how it functions the way that it is. What is money? There are no rules that says money needs to be a store of value, a unit measure, or anything like that. There are no rules, right? And you'll notice the people that kind of blindly believe that, they're not actively managing money in markets, right? They're speculating from the sidelines. And when you begin to understand that money is a web of an asset liability relationships, then you begin to recognize that there is no rule that says the Treasury needs to do X, Y, or Z, or the Fed needs to do X, Y, or Z, or everyone needs to buy or sell a certain asset. You begin to say, what are the different players in the system? How do they have different relationships? And when you have transactions between those relationships, that is the flow. And you can go through the entire live stream slide deck right here. These are sent out every single day so that you have every single thing to be able to make an informed decision and be successful. And so when we come to where we're at today, what I want to really focus on is we have the hyperliquid news that came out. And again, that's very key for everything that it's taking place on the larger picture for AI, how it's converging with the renaissance that we are seeing in financial derivatives. The recent tweet by Jeff really encapsulate this, where he says, excited to see everyone come together for this historic moment. The AQA V2 brings the protocol aligned stablecoin model that native markets trailblazed to USDC with Coinbase and Circle's commitment to Hyperliquid. The community no longer has to choose between alignment and, between liquidity and alignment. Our industry will face adversity as we continue to grow. It gives me hope seeing titans of the industry come together to build for users and bring all of finance on chain. The fact that this is taking place right after the ETF launch that happened earlier this week, all of these things are stacking to give you a hint that Hyperliquid's about to be added to the United States. And I think it's going to take place this month. That's my expectation. That's what I believe is going to happen. Could I be wrong on this? Yes.
Whoa.
I think it'll happen this month, okay?
That's a bold move, Cotton. Oh, man,
I think it's going to happen this month. Every single thing is stacking up in my view. Is it possible it doesn't or gets pushed another month or something else? Yes, it's possible. The key thing that I think is the reason why I think it's actually a good view to take is that right now it's not being priced in the market, right? Like the whole idea right now is that, Hyperliquid is still just sitting right here with, below all-time highs. It's benefited as you have HIP3 beginning to scale. HIP4 is not even priced in right now. It's like not at all. And we've seen Hyperliquid diverge from Bitcoin, diverge from equities, benefit. We're seeing continued acceleration of those. We're seeing PER outperform, and then we're seeing the new ETF continue to move in lockstep with a decent amount of volume on a daily basis. When we go to right here, let me pull up the volume. We have 120,000 shares, over 120,000 shares trading on the day. That's pretty significant. That's pretty good. And for PER, we have, about 4 million shares trading on the day. So again, you can see in just the volume where people are putting their money. And all of these small things are indications of where we are. And so we'll be covering the larger macro context and interest rate context. But understanding this, one of the things that I'll say about how hyperliquid connects to macro is that the largest markets in the world are for interest rates and FX, period. Largest markets in the world are for interest rates and FX. Like, just try to get your head around that. Because if you understand that hyperliquid can have interest rates and FX on it, those are going to be more significant, and those can be even more scalable than any type of meme stock or crude contract or anything like that. And I just think that once people begin to recognize that you can have a dramatic change and you have the entire kind of market really focused on the interest rate and FX side and the volume on hyperliquid from that, that's where people really use leverage. And so that is going to be, I think, a really key thing to recognize. And as those progressions take place, that's when I think that hyperliquid is really going to scale. And so when we think about interest rates and FX, that brings us to what I really want to talk about today, which is the interest rate complex and how it functions. And then not only how it functions, but also where we are at in the cycle right now. And let me just pull up, just need to run a script really fast. Running my Claude Code scripts in the background.
By the way, just as you're doing that, some really good questions today so far. So we'll make sure towards the end of that I wish I could flag them for you on my end, but it's not really easy to do. But we'll definitely get to your questions towards the end of the session.
Yeah, definitely put questions in the chat, and then if you're watching this, you guys can reshare it on Twitter. Really appreciate that. And we'll be going over these, and then let's see any. Okay, perfect. Okay, so this idea of interest rates, why do we need to care about it? Why should we even think about the function of interest rates? All of this started when I started the Capital Flows Research Substack, and people were saying, well, I want to have an entire breakdown of how interest rates work. Why should I care about them? And no one really cared about interest rates until they began to go up. And then the people realized, oh, I can't afford a house because interest rates are higher. Wait, what is this new reality that I'm in? And that's why when I started the Capital Flows Research website and Substack, I wrote an entire suite of educational articles on every aspect of macro and markets. And one of them that I wrote is on interest rates, interest rate primer. You should go to this and go through every single educational section of this. You should go read through all the books, and then you should go through all the papers. If you go through all these, you're going to begin to get a very good foundation for how interest rates work. This is one of my favorite quotes that I put in here. The time you know you become a good trader is that first day you were able to win by holding and adding to a winning position. Let me tell you, there are a lot of guys who have traded for a long time who have never added to a winner. And I just think that's one of the best quotes that you can ever think about when you are trading.
Another quick addition to that quote from our buddy Jared Cuban that I just absolutely loved is reframing how you look at losers and winners and not rewarding a loser by giving it more capital or doubling down, but rewarding a winning trade by saying you're doing a good job, almost like a pet. You're doing a great job. I'm going to reward you by adding more capital to that position.
Right.
So I just thought that was like an amazing reframe for myself.
Yeah, I think one of the hardest things is to be able to have this feedback mechanism where you're able to actually take the feedback from your analysis process and mindset and emotions, right? Because I think once you get on sides where you buy something and it goes in your favor, you just think, oh, I'm frozen. I can't do anything. I just have to hold this now. And then on the opposite side, if you have a loser, you just think, oh, I'm frozen. I can't do anything now. I have to just hold this. And both are the opposite of what you want to be doing. You want to add to winners and take away from losers. And I'm just, surprised because I'm always trying to add to a winner now. I mean, I've kind of ingrained it in my mindset of how can I get a good cost basis established and how can I just get a massive position on sides and add to it every single possibility I get and be able to get on sides more and have something where I just get paid to hold risk and take the vol as I'm on sides and my principles protected. That's what I'm thinking about all the time. And that's the entire point of PER, right? When I initially pitched PER, we were, back down at these lows in the sub 350 area. And, we're up now over 100% from these lows. And so a lot of funds or individuals will say, well, we're up so much. Now the position is a much larger part of my portfolio. Let me start to sell a little. When for someone like me, when I'm trying to get paid to hold a risk, I won't say, oh, well, if we just come back down and hit 350, then I would just start losing money. I wouldn't do that from a risk management perspective, and I would adjust my exposure. But I'm not going to sell the thing that's working the best in this period of time. And we continue to see edges get stacked where people are buying more and more and more. And so it's very clear in my mind that the entire industry has been set up not only to misdirect people, but to suppress risk as well. And that's why, when we go over these decks on the interest rate complex and we talk about what is Fed funds, what is SOFR, what's the 2-year, 5-year, 10-year, 30-year, how should you think about those? That's not going to be something that you're going to have people who are just in the asset management space do for you, because their entire goal is to say, let's not dig in too deep. Let's just hold assets for a long period of time. And they want to be in the asset gathering business. The problem with that is that you are going to constrain yourself to a certain set of returns. And it is sure taking a little bit of risk, but when you're thinking about being a risk taker, and that is how you're relating to risk, that you are trying to take more risk and be the differentiator to have a greater return, then you actually have to take control of your own education. And again, sometimes people are not incentivized to educate you. Newsflash. So when we talk about the rate complex, it is the operating system of every other market. There is no single interest rate. The Fed sets the overnight rate, but the curve builds outward with each tenor pricing a different question. This is key. You want to read them as one system. So each tenor is a different input downstream into the market. So you have SOFR and Fed funds. These set the policy rate, the cost of overnight funding for the banking system, drives short-term credit, repo, FX carry, and things like that. So SOFR and Fed funds, they price what the Fed is going to do over the coming years. So when you think about SOFR or Fed funds, those are simply derivative contracts that price the actions of the Fed. That's all. They just price the actions of the Fed. And so when you look at the SOFR strip and you look down at all these contracts, you can go on the CME website and look at all these, or TradingView or whatever it might be. All of these contracts are pricing how many rate cuts or hikes we're going to get between the present SOFR rate and what the forward curve is pricing. So right now, the forward curve, these contracts represent different periods of time. So the Z6 contract is for December of 2026. The Z7 contract is for the end of 2027. And you can see just beginning and end of each section. And the idea is that we are pricing, let's just say between now and the Z7 contract, when this contract, this is the actual contract itself, when it moves down in the same way that bonds move down, the interest rate is going up. And here's just the implied rate. So what you can see is that there's an implied interest rate rising. The implied interest rate of this contract is pricing a higher interest rate between now and the end of December. And when you begin to say, okay, well, where is that relative to where we're at right now? This is where the current Fed funds rate is in this purple line. And so when you move above that, the market's pricing higher interest rates between now and December of 2027. If it's below it, it's pricing cuts. If it's above it, it's pricing hikes. And so the SOFR contracts set the stage for every other interest rate, and then by extension, all capital moving out the risk curve. And so, a lot of things that people talk about the risk curve or liquidity, they're not usually thinking about SOFR or the spreads of SOFR, which is shocking to me because that is the starting point for every other thing downstream. Again, the video that we did yesterday on the risk curve, which, if you haven't gone over it, you should go through the slide deck that we went through yesterday on the asset liability mismatch, how it can occur, what is credit risk, what is duration risk. And here's the visual that I share, that you have two functions in the system, credit risk and duration risk. You have high yield credit, equities, Bitcoin and alts, growth stocks, 30-year US treasuries, investment grade. All of these assets fall on the axis of either duration risk and credit risk. And that's how macro liquidity works. The most important input into that begins to tilt this mechanism is short-term interest rates, specifically Fed funds and SOFR. And so you always want to know what is pricing in those sections. And then once you begin to move out the curve for the 2-year, what you have for the market's expectation of the Fed's path over the next 2 years. When we're talking about nominals, a little bit different than just the SOFR swaps itself. We won't get into that today, but it is very connected to credit spreads, small cap multiples, things like that. 5-year and 10-year, you begin to add duration risk. So you would say, why exactly would someone buy a 5-year versus a 10-year? Or why would someone buy a 10-year bond versus a 2-year treasury or a 30-year? The reason why is because of duration risk. And so you want to understand the relationship between all of these. This is the framing for what is taking place. And so when you begin to think about the tenors and what it represents, the drivers for them are really key to differentiate. And these transmit to different parts of the equity complex, the economy, and everything. So Fed funds and SOFR, those are about the policy rate, cost of overnight banking, a lot of short-term funding. 2-year, we're beginning to go down to what's the policy path. And these two overlap a lot because Fed funds and SOFR, those go out 2 or 3 years. And then you have, the 2-year nominal, which is, distinct from that. But well, again, we're not going to get into that right now. 5 years when you begin to add some duration. And that is what we call the belly of the curve, midterm expectations. It's the hinge between policy expectations and term premium. So that's why a lot of times I'll look at the 2-year, 10-year spread and that curve, because that shows where we at with the Fed as it relates to near-term inflation expectations. And you can see that this tension right here, this 2s5s curve, is showing you the most apparent and direct relationship between what the Fed is doing and how the market's immediately responding to it.
Sorry, just to let you guys know, if he's chopping up for you guys, it's on my end too. Not sure if it's just a little bit of an internet connectivity issue, but I can still hear you. But it's clear for a little bit, and then it kind of gets choppy, and then it gets clear. And so I'm not sure if you're out in the comments, just let us know, because maybe it's just me, but just want to make sure.
Okay, thanks for letting me know. All right, so on this idea of the U.S. interest rate stack, you want to understand all of these, and you want to understand what they are and how they connect with each other. So here's what we're at right now with 3-month bills. You have 2-year, 5-year, 10-year. Right now, the curve is upward sloping, where if you buy a 30-year, you get paid more. Actually, pretty funny today in the, what do we have? Why don't we just get controversial just for the sake of it? There was a tweet that I put out. Yeah, here we go. That I said, there's a new KOL added to the Eurodollar system. Thanks for playing. And it's a quote of Andrew Tate now talking about U.S. government bonds. I mean, what part of the stack, what stage, right? U.S. government bonds are selling at, 30-year bonds at 5%, life hack. I mean, I guess, that's financial advice. People can take it of just putting money into bonds and you get paid. Imagine that. You learn something new every single day, I guess. But I think that when you think about these interest rates, yes, we're at 5% in the 30-year. The higher 30-year interest rate goes, the more attractive it can be. Now, here's the key thing that people are not talking about. When we talk about interest rates, what we want to do is look at what are real interest rates for the 30-year doing. Because, for example, when we look at the long-term chart of 30-year interest rates, this is what they're paying in real terms. And we're actually at highs. That's very different, actually, than the 5-year, 30-year interest rate, which, yes, we're also a bit more elevated, and we're almost at the same spot. But you can tell that 30-year nominal is at 5%, 30-year real is at 2.5%. So all of these, the fact that 30-year interest rates are this high, 30-year real interest rates are this high, and we haven't cracked anything in the system, and the fact that when you look at, the real estate sector, especially REITs, and we're barely off highs, and when you look at home builders, sure, we're back down at lows a little bit, but we're holding these levels, and it's showing you, yeah, interest rates are hitting home builders a little bit, but in terms of the actual risk in the real estate sector, we're not seeing it. And so these are all the things that I'm always watching to say, when these interest rates are moving and when we're moving across the curve like this, what is the response that we are seeing for all of the equity sectors that we're taking place? And I have a slide on that I'm going to cover in a moment. Duration risk is inflation risk, concentrated in the long end. So the same inflation surprises price differently at every tenor. So a 50 base move in the 30-year can wipe out roughly 8% of the bond volume, where the same move in the 2-year can cost 1%. And this is just what we call convexity. Knowing where the curve inflation gets priced is half the trade. So the idea here is that you want to look at what is inflation pricing across the curve. And I'll show you what that means right here. If you go to inflation swaps and you say, okay, well, let me look at where we're at with inflation swaps right now. Overall, the 1-year inflation swap is at 3.3, the 2 years at 3, 5 years at 2.7. Notice that the curve is falling down. So 1-year rates or inflation swaps are higher than 30-year inflation swaps, right? This matters because you're pricing higher inflation risk in the short end versus the long end. This is going to matter for nominal rates because it's why we've repriced more of the short end than we have on the long end. Those imbalances are what traders are always managing risk around, especially interest rate traders, because all of these curves, for example, if you look at 2s, 10s, inflation swap curve, when this inflation swap curve turns negative, it means short-term interest rates are above long-term interest rates for inflation swaps. And you have a bit of an inflation imbalance in the curve. Now, when you can see here in 2022, this imbalance led the way for the 2022 inflationary cycle. And broadly speaking, what I would say is that we've had some core CPI tick up just a little bit, but broadly speaking, do I think this is going to blow out lower? Maybe a little bit, but not significantly. This is really where you can begin to say, how should I think about the inflation risk in the market? Because what has taken place over the last several of weeks now is notice that as crude prices have ticked up, I've talked about this multiple times, that these higher crude prices, now the question is, how much is that going to transmit into core CPI? Because when we think about inflation, it's not just about crude prices. It's about the entire complex around it and core CPI itself. Once you have inflation at these levels, we have a lot of positioning net long in crude now. Even though some of the premiums have disappeared, a lot of positioning there. At the same time, bonds are basically sitting at lows. So we have a lot more positioning that is saying, I don't want to get long bonds yet. So, maybe long-term institutions will buy a little bit of bonds here. There's always a bid for bonds because institutions have to balance their balance sheet if they give out 30-year debt or whatever that might be. But fundamentally, we are at a point where the forward curve is pricing hikes, which I don't think are going to be realized. I think we'll pause into those, and that will cause real rates to drop further. But long-term interest rates, long-term bonds right here, if we have any move down in crude, that is significant, you could have a pretty significant squeeze in bonds. Now, in my view, I don't really want to be long bonds here because we still need to see the inflation impulse make its way through the system. But on the equity side, that's where it's going to be interesting because equities are pricing the differential of all of these things that are taking place. Since growth is not decelerating and rates are still at these or bonds are at lows right now, the fact that bonds have moved down this much and not even dragged on equities a little bit shows you how strong the credit cycle melt up is. So just imagine if you hop in the boxing ring with someone and you try to push them a little bit or hit them and they just don't even move. It's kind of like that. If you guys remember that scene, I think it's in oh man, what was the movie? I think it's like Superman or something like that, where the guy tries to like push him and like hit him and he like hurts himself, or he's like, oh wait, this guy's basically like a rock. That's kind of
Superman.
the idea that you want to think about in markets, right? Where if you push a system a little bit, how resilient is it? If you throw a punch, how much does someone move? That's going to tell you how strong the person is. And that should be an input into how you're thinking about your action relative to that variable. So the implication of that is that when equities are rallying like this, at the same time, interest rates are ticking back up to highs, it is in itself an indication about how resilient the system is to higher interest rates. VIX still remains at lows. Cross asset vol is not blown out. The entire point is that when you begin to, people are talking about interest rates and how, okay, well, they've ticked up a little bit. The more important thing you should recognize is that, yes, interest rates have risen, but the fact that interest rates have risen and equities haven't fallen, or you've had, again, when you look at equity sectors like XLI that has a lot of sensitivity to interest rates, or XLF, these equity indices are almost back at highs. I mean, they're underperforming a little bit because interest rates have ticked up, but their momentum is still to the upside. We're still seeing some pretty significant resilience in financials, in the entire complex around consumer staples, and then energy is holding these levels in the same lockstep with crude. But when we look at industrials, they're still moving to the upside. And the video we did earlier this week, we talked about things like Caterpillar and how they're connected to this entire AI trade. And when you see these resilient like this, it shows that the parts of the economy that are most sensitive to interest rates are still rallying, which shows that they're not actually being restrictive enough. And so especially something you should watch the IWC ETF every single day, because that shows all the smallest cap companies with the highest sensitivity to the underlying economy. When those are rallying, you don't want to be short equities. And especially if they're rallying when interest rates are rising, it just shows how much growth is in the underlying economy. So the economy can withstand much higher interest rates given where we are at right now. And so when we talk about where we at with duration risk, you want to look at it across all tenors and see how other assets respond to that. When we look at 10-year nominals, break-evens, inflation swaps, interest rates are always broken into two elements. Nominal interest rates. 10-year nominal is right here in orange. That is always going to be driven by one of two things: inflation expectations or real interest rates. Those are always going to net out. So I'll give you an example of this. Here is the 10-year nominal interest rate, and we'll even zoom out even more for you. Let me go to a shorter term one so you can. I just want to explicitly show this, and you'll get the idea of how this is functioning. So you can see here, this is the rate of change in 2-year interest rates. The blue bars show how much is being driven by real interest rates, and the orange bars are showing how much is being driven by inflation expectations. And so I'll pull the cumulative out. You can see 2-year interest rate, how much is being driven by inflation expectations, and how much is being driven by real interest rates. And what you'll notice is that real interest rates were the thing that were suppressing the 2-year nominal rates during 2021. That's because the Fed was holding them down. So that was the real interest rate driver. That's the Fed holding rates above or below inflation. But you can see here in orange, nominal or inflation was actually rising. Then inflation was at this elevated level in 2022, but as inflation came down, and you can see here, the bars are flipped to the downside, the main driver of nominal rates was the Fed and them holding interest rates at an elevated level until inflation fell. Now what's happening is that inflation expectations have driven the price up just a little bit over the last several months in these orange bars, and real rates have basically been kind of flat to positive. So the main driver of the repricing in rates, especially on the short end, has been inflation, as opposed to the Fed trying to take an active stance toward inflation. And that's one of the reasons why we only have a marginal amount of rate hikes on the forward curve, and we don't actually have more, because the Fed is basically not acting. They're deciding to be inactive toward the inflationary impulse that's taken place. And we can quantify that with this attribution analysis. You can go through and just build this attribution analysis yourself. What I would do is just, one, clip, if you're watching this stream, clip the image of this. So just take an image of this, take a screenshot of this, and then go back to the slide deck that I'll send out afterward on the website. And you can go through this slide deck yourself. And you, in TradingView, you can pull the 10-year tip, 10-year tips yield, so 10-year real yield, the break even, and again, go to ask Claude, and it'll find you a ticker for you. You don't have to text me about the ticker. 10-year real interest rates, 10-year nominal, 10-year inflation swaps, and or inflation break evens, and ask Claude to build that attribution analysis for you. You'll basically have a chart like this, and you'll be able to build a chart like that. Super easy. You can do it yourself. You can build all that out, or I'm going to cover them every single day in the live streams that you can cover them as well. So once you begin,
by the way, that chart is like amazing. By the way, that visual, that one, the previous one, like where you brought up what was the driving force here, like between like the Fed stance or the actual like inflation swap stance. That's just like a really cool way to picture that.
I think what I have models that are running across like how much is real rates driving the short end versus the long end. So you can see right now, let's see. Cumulative. Notice like in the 10-year right now, you have inflation swaps. It's primarily real rates on the long end right here, and inflation swaps are to the downside. So the idea is that inflation expectations that are long-term, so 10-year inflation expectations, are not pushing the price up of 10-year yields. It's primarily on the growth side. So the main thing pushing up long end yields, sure, some of it connects to inflation, obviously crude prices, but in terms of how much of it is transmitting to inflation swaps, notice that 10-year inflation swaps, they have risen a little bit, but not a ton. Whereas 2-year inflation swaps have risen a ton relative to its trend. And inflation swaps on the short end are driving markets on the short end more than the long end. And so that's one of the reasons why I think that's why we're in this tension of headline and core CPI, because when I see the 10-year being driven by real interest rates right here to the upside, sure, a little bit of inflation, but a lot of real interest rates, that tells me that there's still a lot of growth in the underlying system, which makes sense because what? Equities are rallying. So that tells you that growth in the system is still positive. And again, just knowing that the driver is real interest rates and long end real interest rates are driving nominal rates higher and that equities aren't falling, you can begin to put together, oh, it makes sense why liquidity in the system is expanding and growth in the underlying system is resilient. Right? This is not rocket science, right? You just pull together these small pieces, and when someone says, oh, well, liquidity is contracting or growth is about to collapse, you just say, well, hold the phone. What about these data points that are the most important, especially on long-term rates, that are indicating the exact opposite? How do we integrate those into a view that we have on how that idea is developing?
So this also gets into when we're transitioning into Warsh here, and in the core CPI versus like um, the I don't know where. I think I read something yesterday. We were chatting a little bit about where he is going to kind of um, push the narrative towards what is the most important inflation metrics to kind of pay
Right.
attention to moving forward. That also is going to play a big role in what we're looking at here, I presume.
I agree. I think that. Let's see.
Like if he's going to signal basically looking through X food and energy more moving
Totally.
forward, right? That's
I
going to
think
help with this
yes.
general thesis.
If you are, so I think this goes back to understanding interest rates. So if you go and scroll back down in the Substack to let's just search it right here for Warsh. Yep, decoding the Warsh testimony. So this was published on April 22nd, right after the testimony that he gave. There's an entire video and slide deck explaining where we're at and how to think about it. And I want to go through a couple slides on this really fast because this connects to exactly what you're saying. So Warsh believes that inflation is the Fed's choice, which means, notice here, if the Fed would have stuck to its 2% inflation goal, which Warsh basically said Powell failed at, we would be here in inflation. We're now here in CPI. This is a massive spread that has impacted every American and has caused inequality to rise. And inflation at the end of the day hurts people whose income doesn't adjust as fast. So when you see this taking place, and then you see Warsh saying, well, we need to shift how we're thinking about things, it means that they're going to shift how they're thinking about short end interest rates. However, this goes back to this entire idea that I said in the first place about, okay, but for interest rates itself, where are we at? What can the Fed control? The Fed is primarily driving short end interest rates for Fed funds and so forth. The Fed cannot control inherently 10-year or 30-year interest rates. If they try, theoretically they can. If they try, like the BOJ did, and they do yield curve control or any type of manipulation, it doesn't matter. The market doesn't care if it's yield curve control or some type of other treasury buyback, or they're trying to duration change, whatever it might be. All that's transmitted into the system and it impacts things. If they try to do that, then what happens? It's reflected in the currency. So at the end of the day, you just need to figure out where the risk is being expressed. So if the Fed makes a policy mistake on the short end, it'll be expressed in long-term rates. If they make a policy mistake on the short end and try to manipulate long-term rates like the BOJ did with yield curve control, then it'll be reflected in the currency of the dollar against every major currency, just like the yen, where the BOJ devalued the yen by 60% in like a year. So risk is always going to be expressed somewhere. And that's why when you have these regime shifts with someone like Warsh, it's going to be expressed. And the way that you want to think about it is, what is the curve beginning to indicate about how exactly the Fed is making an error or not? So bear steepening in the curve is one of the main things that if the Fed making a policy error, that the curve is adjusting to. If it's bull flattening too much, it's probably because they're behind the curve for a recession. Newsflash, we're not seeing that right now. So the whole idea of, oh, we're heading into a recession or liquidity is contracting, again, data's not showing it at all, like in any way, not any time frame or anything like that. So if you want to map the yield curve, there are models for that on the website as well, and you can go through all of those yourself. The main model that you can go through is the yield curve indicator model, which if you look at, this is on 2s10s right now, and what you can see is that we have been bear flattening. So that's important because, I'll actually go to this period of time. You'll remember, let's see if we can see what the look back on this is. Let me isolate the period of time where we had, where are we at? Here we go. This period of time here, especially when we had bear steepening in the curve, and then also these red periods of time where we had also bear steepening, or that's bull flattening. Sorry, hang on 1 second. Bear steepening is orange. So this is it right here. And sorry, let me just orient the chart so that you guys can get the right view of it. Notice, come on. Right here in orange right here when you had bear steepening. That is when long-term rates are rising faster than short-end rates. And it occurs when the Fed is falling behind the curve a little bit. Same thing took place in 2021. We actually had bear steepening in the curve as equities were melting up. Same thing in 2020. Bear steepening was occurring because the Fed was not hiking interest rates. And if you remember this entire period of time when Yellen tried to issue more debt relative to what was in the market, more duration, again, orange, bear steepening in the curve, which means long-term rates are rising faster than short-term rates. So if we start to bear steepen, that is something you're going to want to watch. We're not seeing that right now. So that is one of the signals you want to watch. And this indicator is on the website. You can just go to the website right here, go to all the educational primer section right here, scroll down, go to yield curve model. It's right there for free. You can download it, go through it yourself.
Question on that. If you could go back to TradingView, where you had the regimes there, would you, gun to your head, kind of think that, like, do we often go from a bear flattener to a bear steepener? Is that something that occurs often? Is that where you're seeing the end game leading to, where we're going to kind of drive into that regime while things still are melting up, and that will be the ultimate signal in the end? If you had a gun to your head, if, like, you know, obviously
totally
anything can happen.
So let me answer that question by showing both of these 10-year interest rates. Yes.
Just because, like, when you pull that out, like when I'm looking at the YC regime stuff, I tend to see a lot of purple and orange kind of coupling together.
Right.
So.
Yep. So when this goes into what exactly is bear flattening. So bear flattening is when both interest rates are moving up at the same time. However, bear flattening itself is when the front end is moving up and the long end is not moving up as fast. So basically right here, you have, you know, functionally short-term interest rates. Sorry, I'm trying to pull this.
Love this one, by the way, this visual.
Yeah, I like it. Give me 1 second. I'm trying to pull this thing up.
Yeah, guys, while he's doing that, this is something I'm trying to personally think through is, as we move into the end game, if regimes are shifting, I'm always thinking, how am I personally positioned into this, and what are the range of outcomes of that? And we're going to touch on that a little bit later too.
So what we can see is bear flattening, this purple regime. If you kind of have difficulty understanding these regimes, just put the 10-year interest rate and 2-year interest rates on here. And what you'll see is, let's go to the low here when everything kind of started. And instead of the outright yield, let's look at the percentage yields. Notice that over the last, let's say this is from March, so when the crude spike started, 2-year interest rates have gone up more than 10-year interest rates. That is in itself an indication of bear flattening. So both interest rates are moving up. So bear just means bonds are going down, or the outright contracts are going down, interest rates are rising. And then you have it flatten, which means 2-year interest rates are rising faster than 10-year interest rates. Why is that? Because short-term inflation expectations are rising more. The long end, you could say, is looking through it, or it's either looking through it. We don't really know the answer to this, but it's either looking through it and saying that this inflation spike is not going to be persistent, or it's basically saying the inflation spike hasn't transmitted through the entire system and we're waiting to reprice it once it actually happens. And that's why I talk about this entire idea of core CPI, because if you have core CPI begin to tick up in a significant manner, you will flip to bear steepening, in my view. I mean, this is my probabilistic view, that if you have headline seep into core, then the long end can't really deny that, and it'll begin to say, oh, okay, long-term inflation expectations have to rise a little bit, and now we have to reprice, and we have to bear steepen a little bit, especially if the Fed pauses into that. And so oh man, PER's up 18% of the day now. Good news.
Focus, bro. Focus.
Okay, I'm sorry. I'm sorry, guys. I'm just happy. What were we even talking about? What are we?
No. So on that note, I just think that like scenario planning, like I'm thinking through Warsh coming in, having that optical narrative guidance, and we could see, it's been an extended period of time with like this energy shock, and who knows what else is going to happen geopolitically. But I could see this playing out, like where he's going to come in, he's going to not cut rates right away. It's going to be this maybe like extended price window of pausing while it seeps into the long end a little bit. And then people are realizing that's not affecting equity performance. In fact, real rates could still continue lower. And then you could have this melt up occur as the bear steepener gets more aggressive, to the point where that's like where things can start to throw some real interesting signals at us.
Totally. I think that's, really interesting situation, because that is, people kind of ask me sometimes, well, real interest rates on the long end are rising, but short end real rates have fallen. And they say, well, isn't that bearish? And the entire idea is that you can have pockets of time where you have a divergence in interest rates, and that injects liquidity into the system, even though inevitably the longer term real interest rates are going to probably, eventually rug pull the market. And that's why when I talk about like, well, we have a credit, cycle melt up and it's not going to end well. Well, there's a reason for that, right? It's not just me saying like, oh, well, it's not going to end well just because it's not going to end well. No, like it's because there's a divergence and an imbalance that's occurring. We don't know how long that will take place. It really depends, but understanding the system around it is the differentiating factor for it, if that makes sense.
Yeah, I think that there's a question here that's saying by Joseph here that says like, so the melt up's just getting started. The bear steepener is the final chapter. Like that's what we're talking through. I think that's something that's like great to kind of project out and think about. Doesn't have to be, right? Because so much could happen between now and whatever. But I think it's just like great to start thinking through what could be your base case, what could be your tail risks, things like that. So I think that's great.
All right. Let's go. Where are we at? Perfect. Okay. So again, go through all these curve regimes, spend time thinking about them, and really spend time connecting them to TradingView. And watching the curve, here's the thing I'll say about the curve. I put a note here that a lot of recessions were preceded by curve inversion, but the thing is not every single one. So you can have a curve inversion that doesn't follow a recession, primarily because you have bear steepening, which occurs into higher nominal growth. And so you really want to think about why exactly the curve is moving in the way that it is, which goes back to that attribution analysis on real rates, inflation, and term premium, just the idea of the yield curve. Which parts are driving the yield curve overall? And this is how you want to visualize something like the 10-year nominal yield. How much is driven by break-evens versus real interest rates versus whatever residual exists to say this is, when people talk about term premium, all that really matters for anyone that's trading interest rates is yield curve. So when people say term premium, just think yield curve. And people are going to say like, oh, no, that's not technically right, blah, 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 blah. Like, dude, none of those guys are trading rates. They're just out here as academics trying to, wax eloquent. And, they've never sat in the ZN order book watching it and saying like, let me just see if I can lean against this level and get a trade on size. Like none of those guys are doing that. So 10-year
Don't
yield.
tease me with a good time. ZN order book. Ooh, I love the ZN order book.
I think the amount of time that just sat and looked at the ZN order book. I remember there was what was it? There was some quote on like this like artist who was like he never left his hometown and he just stayed there, lived a peaceful life, and then like died in his hometown and he never like came out. There's like some quote that was going around Twitter for a while, and someone reposted it and just said like that this is like what it's like to be a order book trader who only trades one market their entire life. And then he's like, this is what it's like to be a ZN order book trader who has never seen any other market, has only seen ZN. It's just kind of funny because there's always that guy who's just like, wait, there's other markets? I just always look at the ZN order book and I just like, just watch
he would know who the 888 guy is. I don't know if you remember that. The 888 guy, if anybody out there has stared at a ZN order book enough and you don't know the 888 guy from the past few years, then you haven't stared hard enough. Keep going.
Careful. Don't tell everyone the secrets that we have. You're not supposed to tell people this stuff.
It's Jay Powell. He's leaving soon, so maybe we won't see him anymore.
We can't even get into icebergs and orders and everything. We can't even get into
that. No, we're not talking about that stuff. Okay, that's not for the live streams.
I know. Sorry.
No, everybody knows what they are. I'm just joking.
All right. So going back to the this idea of these different carries. You have different interest rates across the curve that are signaling different things. You always want to look at those as it relates to inflation expectations and rates and things like that. Rates set the discount rate, credit prices the risk premium on top of it. This is key because this is what we would call an equity risk premium. So every credit instrument is a treasury yield plus a spread. So just think about it. If you're going to get a mortgage rate, 30-year mortgage, it's going to be whatever the 30-year interest rate is plus however risky you are. So, James would probably have a really high risk premium because he's a really risky guy. That's just who he is. But you'll have investment grade spreads, tighter spreads, EM debt, wider spreads, high yield, wider spreads, structural credit, depending on what it is, can have a little bit higher, lower, depending on what it is, and liquidity for it. All of these things function as risk premiums, but they operate based on the foundation of interest rates. And so when we talk about the rate, the credit cascade that can take place is when you have Fed expectations change, that transmits into the premium on the US Treasuries. That can change default expectations. And that can also reverberate across emerging market debt because the dollar strengthens or falls. And then people might say, I need to start allocating less and begin to hit downstream markets like private credit or CLOs or things like that. The opposite can take place as well. You have positive things take place where the Fed cuts into a positive growth environment. It causes equities to melt up, aka the period of time we're in right now. Default expectations fall. That's where we're at. Defaults are not rising right now. EM debt is fine, which is where we're at. Just look at the Mexico ETF. And private credit is still doing fine, which it is right now. People like to talk about private credit when the equity market was down earlier this year, and now no one's talking about it. So the 2-year yield really is an important input into high yield spreads because notice right now, 2-year yields have risen but they haven't dragged up high yield spreads, which means that we're clearly not in restrictive enough territory. So rates set the discount rate, sector betas dictate the rotation. So if one sector is making more money than another, that's why someone might sell one stock and buy another, because they think that you're going to have better performance during a certain period of time. And so sector beta to the 10-year yield is something important to watch, something important I watch all the time, especially for materials, banks, energy, all of these things with tech, REITs. We just looked at REITs right now. If you look through, the sector returns right here, there's a reason why we have a dispersion taking place. Tech is up the most, and then you have, things like IGV within the tech space that's finally up, and then you have SMH obviously up on the day, and you have all these other sectors that are lagging a little bit, which tells you about the concentration that's taking place. RSP is now up on the day, it was down on the day yesterday, but you can see that SPY and RSP, just the ratio, basic ratio, we continue to see a concentration in Mag 7 and tech and semiconductors, especially things like NVIDIA pulling the index up. So NVIDIA is making a new all-time high today. Again, don't bet against the leather jacket, right? Like, it's just, the entire point is that we're going to keep melting up because there's so much capital in the system bidding all of these things from the demand side. And it's still underappreciated. And on top of all that, again, we've covered this so many times. Go through all the videos we've done this past week. You just need to get the context for those, because that explains everything. And what, you can go through the rest of these slides and begin to break down, okay, FX prices, carry differentials. You basically have how different countries have carry between the US and other countries and how you can generate yield from that. FX carry, and then you have, one of the biggest things for Bitcoin that people don't talk about, and I haven't talked about as much just because I kind of keep it on the down low a little bit more in how to actually model it, is how FX carry trades impact Bitcoin, because Bitcoin is a global asset. And so if you were going to understand the global dollar liquidity market, you need to understand carry, which connects to Bitcoin. And it's, again, something that is less understood because people who talk about Bitcoin only are pretty US centric, and they only look at the Fed balance sheet and M2, which right now, not telling you very much. So you can see, right here, the differences between, real rates, dollar index, and things like Bitcoin. And these all frame kind of where we're at on a larger picture basis for everything. My view is Bitcoin's probably going to move higher from here, but it is really still underperforming. And all the capital is being concentrated in the semi space, which is why I'm more interested in Oracle than I am in Bitcoin from a trade perspective. So the daily breakdowns, or the daily things that you want to watch, are on all of this list right here that you can go through in the slide deck. This will be available afterward. And if you have a Bloomberg, you want to watch, swap spreads, obviously, and all these different changes. If you don't have a Bloomberg, the best thing that you can do is be able to show up every single day or be a paid subscriber on the Substack, and you'll get a breakdown of all these factors. But the best thing you can do if you don't have a Bloomberg is come to the live streams every single day and read every single report on the Substack, because that is what is going to really show you any of the data that you don't have, or any of the data that you basically need to cover in terms of where we at within interest rates, the curve regime. One of the things that I map a lot is, well, we're at, bear steepening, or what regime are we at for across the curve? We have bear steepening in short end nominals, but bear flattening in long-term nominals, which tells you, again, this is the tension that we're in right now. This tension that I talked about with headline and core CPI is reflected in short-term versus long-term nominal rates right now, where you have bear flattening in long rates and bear steepening in short-term rates. Why? Because inflation expectations are rising in the short end, but it hasn't transmitted to the long end, and the long end is either looking through it or waiting for that headline to transmit into core, which is why watching those is so important, which is also why watching things like XLB and CF and all the names that have rallied the most, which I've been covering in all these live streams, all these names that have been rallying the most, all the energy prices, food prices, if those make new highs, that probably tells you about where we are in the inflation situation. So you want to watch those with interest rates. So if the XLB ETF begins to just rip to new highs, probably don't want to be long bonds. So especially if it's outperforming the rest of the index and crude makes another high as well. So this is the tension that we're in. We already had the initial impulse from the crude side of things. Now you have to deal with the second and third order effects. And so the idea is that all of these different factors for the slide deck that we just went over, and we talk about all the rates that you need to be watching, kind of what those look like. You can build this all out in TradingView. It's very easy. When you want to read how these interest rate changes really connect to the credit cycle, which we're doing right now, and you can see in real time how the higher interest rates, because of understanding their drivers, you can understand that growth in the underlying system remains resilient and the credit cycle remains in full swing. Understanding these is the differentiating factor to be on the right side of the macro regime. And so that's why, the entire point of what we're doing every single day here is mapping the macro regime so you're on the right side of it and taking a few large asymmetric bets within that. And again, everything is laid out in capitalflowsresearch.com. I've been laying out the, basically the two large bets that I have right now are PER, which, everyone hopefully knows that by now. I've been laying it out since the $3 sub 350 mark, up, almost 20% on the day now. Bitcoin's finally bidding as well. Hyperliquid is bidding. Oracle is finally, ticking up as well. I've been long Oracle basically since the 154 levels. So we're up almost $200 now. I think we hit $200 on the day. Let's see. What are we at on the high of the day? Yeah, we hit $200 at the high today. So those are the most asymmetric bets that I view in the system right now. If those things change, I will lay them out on the website, and everything will be laid out here at capitalflowsresearch.com. So if you have any questions, what I would do right now, put them in the chat, and we will walk through them in real time, and we'll walk you through how to think about them in TradingView, because these are the times where we're not just talking about market views. We're talking about how the underlying presuppositions and logic behind those market views will set you up to know when you need to change that view and how to adjust exposure accordingly. Because right now, when you begin to pull all these little moving parts together, they are the pages of the book, like James would like to talk about, like James talks about, where, if you can get where we are right now, then it can help you understand the future probabilities in a much clearer fashion. And that is really going to set the stage for how to think about this future probability of, expectation of outcome, and how exactly that is going to be framing for kind of on a mindset basis, how you're going to execute for that. So we're going to cover all the questions here. I want to have James share a few things from his side, and really how to take these ideas that we're talking about and connect them to what does it look like to make decisions in this macro edges that we're talking about, and the macro logic we're going through.
Yeah, so one thing I'm going to try to do, guys, is I'm going to try and think back to our previous conversation, which we touched a little bit on this stuff yesterday. And if you were here, maybe you'll catch it. If not, whatever. And I want to talk a little bit about, from my perspective, how I think through mindset, execution, stuff like that, that is a little less on the technical side of things, where Flows specializes, and a little bit more down to the execution side, where I kind of thrive. And that's kind of why we like what we're doing here together, is because, like, you could be one of the smartest analysts in the world and work at Citadel or whatever that London-based fund is that crushes it, and you could be all great, but how do you actually execute on that idea? How do you get, the best positioning, ride it for the most, asymmetric outcome? You need both sides, right? You can't just be an executor either. You need to have some sort of base level knowledge of like, what regime we're in, what assets are going to perform the best, or else you're just going to be picking the wrong things at the wrong time. So I think day to day here, I'm going to try to add a little bit of value for you through that line of thinking as well. And hopefully, it helps at least one of you make a little bit of a better decision or execution. So I was watching a podcast the other day. I believe it was the CFO of Anthropic. Great podcast, a bunch of killers there, like pretty unbelievable squad. And he was talking about how at Anthropic, they're always thinking about things through a cone of uncertainty. I thought that was a really interesting thing. And from their aspect, it's like, hey, if we spend all this money on compute, or we spend it on hiring, or we spend it on making things better for the customer, how does that outcome look in all sorts of different scenarios? And then they try to decide what would be the best course of action for them to like allocate capital or time or effort to. And I always try to tie things back to trading, right? And I just was like, oh man, this is just so good, because all we're ever doing in trading is looking out in this cone of uncertainty and trying to figure out, what to do, because we don't actually ever know, what the outcomes are. So it's a little bit of an interesting thought experiment for you guys to think about, is like looking out into the future, taking a snapshot of where you are right now and your portfolio and your positions and all that, and thinking through what are the different outcomes possible, going into the future. So you obviously have like the top end of this cone would be the best possible outcome, and the worst is probably you going bust and having to open up like LinkedIn and start messaging people and say, you know what, trading's manipulated. I don't know why I ever did that. These are the tails, and we tend to like live in the tails too, right? Like social media, FinTwit, whatever. The things that attract you are the tail events. But if you think about it, like, where is your portfolio going to perform? What is your base case? What are the tail events? I think it's important for you to just sit back and start scenario planning. And I think, Flows, you show this constantly on your feed. It's one of the few clips you always go back to with that one bald dude, right? What was his name? The one where he's always talking about scenario planning.
Yeah, it's the old Goldman Sachs CBO. I think it's like Lloyd Bankfield or something like that. Like basically a guy that you're just like, you went to an Ivy League school, didn't you?
Yeah. Yeah. So, I mean, he kind of makes, he's a risk mitigator. He's a scenario planner, and that's kind of how he thinks about things. So I think they, maybe without saying cone of uncertainty, they approach markets in the same way. That it's all about thinking through probabilities and base cases and tail events and survival, right? And like, is it set up? Is your portfolio and positioning set up in a way to give you extreme asymmetry and the best possible outcome, right? Do you have the big green arrow here when things are going well? And have you defined your downside in the worst possible outcome? Like, can you save yourself if this is the outcome down here? Can you save yourself from going bust? That's a question I think you need to wrestle with, right? And it's something that sometimes I've stopped myself and I've looked at the snapshot of my portfolio and I've realized, wow, if this goes wrong, this could be really bad, and sometimes people are like, they think that and they think, whatever, like, hopefully it doesn't happen, right? But I live in a high tax state. I have a family. I have a certain lifestyle I want to live. I can't even like give that potential, right? So even if I keep my portfolio that way, that gets into the whole risk management side of this, and like, how could I prevent that from happening? And look, we all focus on the best possible outcome, the worst possible outcome, like a high percentage of the time. But I think we all know that the most likely outcome is somewhere in the middle, right? So are you just buying like super aggressive calls, or are you buying super aggressive puts? And do you think the world's like falling apart, or are we going into absolute 2021 euphoria? Like, those are cool to think about, and it's fun to be positioned asymmetrically for in certain cases. But like, guys, 95% of the time we're going to be falling into this bucket right there, right? So something for you to think about there. Then this gets into a little bit of visualization. Here's my little Buddha here, my little floating Buddha. Putting yourself in your head into each of these outcomes and thinking, how would that actually make you feel and act and maneuver your portfolio in the moment, right? So what I mean by that is, like, let's say that we go along this path and you are just crushing it. Let's just say you're a person with 100K net worth, right? You got 100K, life's fine, you're used to 100K. This is who you think you are. You're a trader, you got 100K. All of a sudden you have this extremely asymmetric outcome, and now you have 800K, right? How are you going to deal with that? Have you ever pictured yourself or visualized yourself with 800K? If so, like, what are the decisions you're making? What are the lifestyle upgrades you're making? What are the tax implications? How is your sizing changed? Are you changing your sizing? Like, what are you going to do to protect that? Are you going to stay offensive? Are you going to switch to defensive mode? How's that change things for the next 5 years, 10 years, whatever, right? Have you even gone through that process? Also, what if we end up tracking here? You go from 100K down to 25K. Whoops. How does that change your life? How does that add stress and pressure to you? Do you have a job? Do you have an income? Do you not? If you want to be a trader forever and you haven't thought through this scenario and what you would do, then you're going to need to start thinking about it, because it is possible, right? It's a tail event that could occur. So visualizing yourself here and here is going to be like vital, because once you actually get here, you'll have at least contemplated it, and you'll be able to think of it clear. Because you think you're going to be thinking clearly when your account blows up to 800K or your account drops to 25. Like, you're going to be a different person at this moment. So you need to try and step into that person now, right? And try to adjust accordingly where we are now to match that scenario. And of course, again, it's going to go, it's going to end up somewhere in here, but it's good to think through all of these. And this feeds into my, archetype stuff. If you've ever watched my videos, like, how are you going to actually feel in those moments and emotionally respond to being up, down, sideways, whenever X outcome occurs? Does it get you excited? Does it scare you? How does that align with your risk tolerance? Flo's jokes that I'm a risky guy. I'm not, right? I'm actually pretty risk averse. So I am attracted to asymmetric opportunities with limited downside, because I'm good at holding trades and I can explore the upside and I feel confident there. But I really hate the idea of large drawdowns, and I don't deal with that well. So that's how I position my portfolio accordingly, right? So that I can help avoid large blunders down the road, which most people just run into their blunders without ever thinking that could have even possibly happened. You need to be the one who has seen that and be able to adjust on the fly. So here we are. This is what I think, kind of summing this all up. Most people are stuck here in the moment. Oh my God, PER's up today. Oh my God, PER's down today. Oh, this guy doesn't know what he's talking about. Oh, this guy's a genius. Everything is about the here and now. And they're not thinking forward enough, especially if things are so exciting and moving so fast right now, that like, it's hard to just sit back and think about the future. But I would definitely ask you to do that, because in the end, like I said, my strategy with all this, working with flows and doing what we're doing here, is to learn his framework, combine it with my archetype, my lane, my execution style, to ultimately reach this epic edge and outperformance here. And everybody can do it in their own way. So I'll leave you with that. And Flows, I want you to touch a little bit on anything that maybe stood out to you here, but also like when it comes to you and your portfolio, we all know that you're kind of taking huge bets with huge asymmetry and you're willing to risk a lot more than other people. So how do you think about scenario planning through all that with the idea that you have an income? Maybe that helps you have a clear mind, maybe it doesn't. Why don't you kind of share a little bit of insight into that?
Yeah, absolutely. I mean, I think that it goes the fundamental idea that I think about the most, and I think this is born from our conversations, is having, I think there's this like tension of having this expectation of, well, you're probably like, if I have this big bet, I'm probably not going to execute it perfectly, right? And recognizing that, like, okay, I'm probably not going to bottom ticket and top ticket, right? And let me give myself a little margin of error and not think that I need to wait for this perfect moment. But how can I have a, an accurate understanding of my own abilities? With that being said, I feel like you have to weigh that against the positive. I don't even know if it's positive and negative mindset, but it's just an understanding that you're never going to act as well in the future as you think you will right now, but not letting that be a limiting belief, right? That is kind of your safety net for risk management, but being able to have beliefs about who you are and what you're doing that are based on your active agency and initiation to focus and own all of the things that are in your control. And I think that's just so huge, because when you do that, clarity comes, right? I think that when I think about that type of stuff, I need to make sure that no matter what, I need to have enough money or cash flow or whatever it is, not only to maintain whatever life I have or other people or organizations, right? Like any giving that I do every single year, or any things that I'm involved with other people or church or whatever that might be. And then also just my ability to run my own business and the expenses for that. How do I have a realistic expectation about those? And then at the end of the day, take the trade-off. I don't think there's anything wrong with saying, hey, I'm putting it all on the line to do this. If you recognize that you're saying like, oh, I'm putting it all on the line, and the upside can be a night and day difference in X, Y, and Z, and I hit all my goals, and the downside is maybe I get reset and I have to build my life back up for a year or 2 years or something like that, whatever it might be for people. I don't think there's anything wrong with that, as long as you keep your seat at the table and you have the understanding that that is the risk that you're taking. I think people try to like not think about the risk that they're taking, right? They'll buy some, it's like people will buy something and then not put a stop in or not size it correctly because they're just like, I just don't want to think about it going there. And I think we do the same thing in life, because we're just like, well, I don't want to think about how things can go bad, so I'm just going to ignore it. And I just think being able to just be very sober minded and understand how that functions is just absolutely critical. And I think you get tested on how well you have those convictions integrated into who you are when you have extreme moves on the upside and downside, right? So I think, right now is a perfect example where things are working out, amazing, right? How should I think about that clearly, right? Is what we are seeing right now moving and the extreme of my thesis right now with per outperforming, everything's going right. Some people might say like, oh, I want to take off a little bit. And maybe that's what they need to do. For me, I am always trying to, and I think there's actually a great question in here. I'm just pulling up your chart too. There's a great question. Oh, where did it go? Yeah. No. Here it is. So holding positions until a certain macro change, not necessarily based on price targets. I don't know if this was related to the per thing or something else, but what I try to do is I don't like this idea personally. I don't like this idea of price action that doesn't connect to my thesis. If I don't know why something's taking place, I will literally get out of the trade or put my stops and break even. So for example, if I don't know why we are having a change in price action, even if I get on side, sometimes I'll just take off the position because I'm like, well, I don't understand why that's taking place. It's not in alignment with my thesis, which means I don't understand what I'm doing right here. And I'm just going to take this off until I understand. And maybe I'll understand tomorrow and I'll just put the risk back on. I think that's one of the things I always try to come into every day thinking is I can take risk off and then I can put it back on the next moment. 10 minutes later, maybe. I mean, you're probably not thinking about things very clearly if that's what you're doing. But, always being open-minded to say like, well, I can take the risk off and I can just put it back on tomorrow, or I can put it back on later today, or whatever it might be when I'm thinking about things clearer. And I think that's totally fine because you're preserving your mental capital. So I always like trying to connect price with my thesis so that I know why everything's taking place. I don't like this idea of like, well, I'm just going to get out once the macro regime changes. Well, fundamentally, price should be an input into your macro regime, right? And vice versa, right? Like your macro regime should have a very clear view of where price is going. And those should operate in confluence to come up with a view. So I think that's just really important.
Yeah, this question, just throw it back up for one more second. See, I would say this question clearly aligns with you a little bit more, right? Where you're going to look for signs to be like, okay, I think that the regime is heading somewhere where there's no confluence and it doesn't make sense for me anymore to be in this position or whatever. But I think the per position is so interesting because it is such a obscure play. And for somebody that follows your work and knows that you're all in and basically was there around the start, and they might push their position size a little bit higher because maybe they have some added conviction or something like that. If they haven't thought through, this is where sizing, risk management and sizing matters so much, because like if you're somebody that has X amount of money and you put in a large portion of that into per, and then let's just say it works out and it's now a huge percentage of your portfolio. If you haven't thought through and scenario plan how you are going to be able to handle the swings that come with per as a huge percentage of your portfolio, I actually think you sized it completely wrong for yourself. Because if you, let's just say, again, I'll use the 100K example. If you put 50K of your 100K into per and you manage to hold it to now and you're up, to where it's like 70% of your portfolio or whatever, and then it goes down 30%, but the thesis and the regime and all that hasn't changed. Have you considered how you're going to feel losing a couple $100,000 or whatever it ends up being of your portfolio? Have you ever even experienced that? How is your conviction going to hold through that? What type of other decisions are you going to make in your other portfolio or other trades? Because like maybe you want to chase that back. Like what second order effects could come from you sizing improperly because you're trying to be like somebody else, or you're trying to get the results of somebody else. So Joseph, I'm saying like for you personally, let's say you're in this trade, maybe you don't hold on to trades that well. And it's more important that you actually take some off the table as it goes up so that you can preserve the mental clarity of your per position moving forward. And if you're just trying to like hang on for dear life because a macro guy is holding it until the regime changes, I'm just saying it's very unlikely you're going to be able to do so. And we've talked about this before. I'm going to manage my position differently than Flows is going to manage his position, even though we talk about it every day. I will take winners along the way. Like look at this chart I just did. We're at a 1.2 MNAV, right?
Right.
And I know personally that like Shemus, the CEO, has talked about this band of like 1.9 MNAV is where maybe they would consider selling some stock to buy back lower, stuff like that. I'm thinking about all of that in my calculations. I'm like, well, if I see it ramp up extremely fast and it goes to like a 1.6 and I'm not comfortable having it as such a large portion of my bankroll, maybe that's actually a good position to front run them selling. And I'm thinking through a trader's perspective. I'm not thinking about, oh, well, no, we're going to move into a bear steepener phase. And then once that happens, I'll think, I'm completely different than what flows might be doing here. So just food for thought on that. I think that's a really deep question, even though it seems simple.
Yeah, I also think that one of the things that we are intentional about is how do you, for what's best for your mindset and risk tolerance, preserve your mental capital, right? Because if your portfolio is moving around by a certain percentage or a certain dollar amount and you're not used to that, that's going to cloud your judgment and you're not going to make as good decisions. And so like sometimes people take away exposure, or, people should take away exposure just because they're not thinking as clearly about things, right? And they're trying to preserve their mental capital, whether it's on the upside or downside, right? And I think that's one of the things I always am thinking about is not like, oh, could I lose some money? Because I feel that I can always make money, but I want to preserve my most important asset, which is my own mind, my own state of being. And people who aren't doing that, it just shows that you're not betting on yourself, right? You're thinking like, oh, like, let me just like have this happen once and I'll be fine and something like that. And they're not actively asking themselves, how exactly am I preserving my own mental capital? And even for both of us, I think that when we talk, neither of us are trying to project our own risk tolerance or kind of sense of the market on the other, right? I think that's one of the things in our conversations where you will help me or I'll help you. Like, how can you be better as the risk taker you are, instead of, oh, well, like, if you're like, well, I just want to peel a little off of per, I'm not going to come to you and say like, no, don't do that. That's not smart. Like, I would never do that, right? It would be, well, how can I help him make a decision that's best for him, not just projecting my own like insecurity of like, well, someone's doing something I don't want them to do.
Right. And for instance, like you have an income, I don't have an income. That's a big difference.
Sure.
Big difference. My income is based solely on trading at the moment. So like if I come to you and I say like, hey man, the MNAV on per is expanded quite a bit. I don't have an income. Like I'm being vulnerable.
Right.
I don't have an income. This is actually a pretty large position for me. Like, can you just walk me through your thoughts on me just like taking 30% of my position off here? Like, do you think that's what do you think about that? Like you could be honest with me or whatever, right? And then we can have that conversation and then I could go make my own decision. So I think that's the power of like, we go back to networking and building the people around you that have experience and think differently and all that, because I'm now going to be able to like make my decision, bouncing that stuff off of other people just a little bit better. But I also have to have the confidence and the self-belief that ultimately it's my decision and I have to make that and I have to live with it.
Totally. And I think that's why we're having these conversations specifically publicly, because these guys who are coming around and just dumping on other people while they're taking a risk or something like that, or like, if you come up with an idea of like, and people will always like bash him like, oh, what an idiot, he doesn't know what he's like, it's just not the type of mindset that any real risk taker has. And I just am, not really supportive of just tearing people down, even if they're early or late or wherever they're at on their journey, right? Like, I just think it's so important to curate and help people realize this is the type of mindset that you want to have. These are the type of people you want to surround yourself with. And if you have someone in your trading network that is not trying to help you become the best version of yourself instead of just projecting themselves onto you, that's not going to be a friend that serves you well over the long time. And that's, I think hard to hear, because sometimes you have people that are really skilled, but they're not, in understanding the market, but they're not really good at understanding like what might be best for you or how to help you understand more about yourself, which I think is just one of the most kind of important things to begin to kind of build out as a person, right?
Yeah. I think it's a super valuable conversation. Hopefully, everybody is out there doing that exact thing. But yeah. So, anyways, that's all I kind of wanted to touch on. Maybe we can touch on some questions here that wrap this baby up.
Totally. So, couple questions. Could you explain real interest rates in a separate video? If you go on to the Substack, search real interest rates, you'll find a bunch of resources on it. SOFR is currently pricing slightly more probability of hikes, and equities are resilient. Are you looking for when further hikes being priced in makes a negative impact on stocks? Yes. It will likely take place when real interest rates on the short end begin to rise and the curve either bear steepens or bull flattens or something like that. It really depends on how much inflation risk we have in the system. But yes, once rates move up too much, they'll pull on rates. They did the other day, right? On the CPI print, bonds were down, stocks were down. They dragged on them, right? And if you were a subscriber on the Substack, you saw the note that I put out where I just said, I think that bonds could drag equities down intraday or maybe intra-week, but it'll revert back up. And that's exactly what we've seen. My entire view, I've laid this out so many times on Twitter and the Substack and everything. Stocks are going to outperform bonds. That's the environment that we're in right now. And that is not going to change until inflation risk falls. So, all right, a couple other questions. If you have questions, put them in the chat. Why do you think that BKLN, HYG, and XLF are lagging the rally in semis? Very simple. We're not seeing them move down, which means that delinquencies aren't rising significantly. However, the entire concentration in capital right now is in the semi space because they're providing the most upside in markets right now. And right now, we're not seeing enough delinquencies in, or we're not even close. Even all the credit that's getting issued for all of the infrastructure build out space is not even close to coming due. So it's hard to even price, oh, this company's about to default on it. All right. A lot of this still connects to the fact that you have everything as a one-way trade on AI. We covered this in all the live streams yesterday. This is a great question. The gold and silver side, I think part of it has a connection to the dollar, which is connected to rate differentials. So I think the dollar is going to move down eventually sometime this year, and it'll push gold and silver to a new high. That's my view. We're seeing that playing out slowly, but the road there to get there is a bit choppy. But we're seeing that move in lockstep. So I think gold and silver will move higher. I think the dollar will move lower. But I think the main reason why it's not moving as aggressively is primarily because of the pricing we're seeing in the dollar. All right. If you go back, well, we kind of talked about this a little bit on the inflation side, but at the end of the day, the inflation and headline side, we're seeing some market risk. I don't want to be long bonds, but we still see low enough real interest rates and enough accommodation that equities are still rallying because of all the AI plays. That's how I think about that. How do natural rates play into your opinion? I don't believe in natural rates really. I mean, well, it kind of depends on your definition. Yeah, again, there's no really way to quantify. Well, there are some ways that you can say what's the neutral rate or not, if you're going to say neutral rate, if that's what you mean. But that is really about quantifying the balance sheet and the risk curve and how rates are transmitted across that. Right now, we see capital moving across the risk curve into the highest risky thing. So it's clear that the neutral rate is much higher. How does robotics connect to Hyperliquid? I'm not sure. I don't think the robotics side is, I mean, maybe we're going to have robots be trading on Hyperliquid in person, and we'll have a trading desk of Hyperliquid robots. Here's what I would say though. If you have a lot more build out of real world assets and robots and things like that, it is going to be a lot easier to have derivative contracts around them, and those would likely be on Hyperliquid. So that's possible. It's kind of in the future a bit, so it's just kind of unknown. I think the AI agentic trading is much more clear connection to Hyperliquid. Robotics, I mean, here's the thing. I think some robotic companies can get listed, and maybe in pre-IPO phase, and that can help Hyperliquid. But like that could be with any company. I don't know if there's an explicit robotics connection. If there is one, I'd love to hear it, and maybe it's a good thing to watch moving forward. So let's see.
Yeah, keep it out, guys. Like keep an eye out for if Hyperliquid does get brought to the US, because some of the stuff going on there is really interesting. Not many people talk about vaults. Not many people talk about the on-chain prop trading firms. Not many people talk about spot stocks. A lot of stuff that's being built on top of Hyperliquid that we discuss personally a lot that could be very exciting.
Yeah, absolutely. All right. Do you think other central banks hiking will stop the market rally? We're seeing them drag on Euro stocks and the DAX right now because the ECB is hiking faster, but those are kind of now moving back up. So, whoops. So, you can see the DAX and Euro stocks moving up. I'm not interested in shorting anything right now because these are still pretty resilient, even though you have higher rates in the Eurozone. They haven't hit all-time highs. We covered this in the live stream on Monday. They haven't hit all-time highs because rates are higher in the Eurozone, because Europe is short energy fundamentally, and they have massive problems over there. Not a great place to be a European right now. All right. Take 30% off and pay down your mortgage. Maybe not on per win. That, again, that goes back to what's best for whoever it is, right? You don't want to project on people. That might be a horrible idea if you have a 2% mortgage, right? And you're a person who is really good at making money in a 30 to 50% returns, right? So, again, you don't want to project, right? And you will trade better anyway. Maybe not. Maybe that actually might be bad. You might actually feel regret. So, and you can also blow it at the club. Maybe that'll help you. Maybe that
the club, blow it at the club.
That's yeah. So, what's the best place to trade per and hype? Brokerage account in the United States. Schwab, TD Ameritrade, Interactive Brokers. I use Interactive Brokers. All right.
For hype itself, for the hype token, you can buy it on Coinbase. That's probably the easiest for a lot of people.
Yep. Appreciate you guys. Macro and Trader's Lens helps with context and execution. We'll continue to do the live streams every single day, guys. 8:30 a.m. Mountain Standard Time. What is a consensus view in the market right now that you believe is fundamentally mispriced? I think the dollar needs to be lower. I think the biggest one is Hyperliquid, but in terms of like broader market consensus stuff, I think that the biggest mispriced risk is dollar hedging flows from cross-border flows. If those unwind, they're one of the largest structural things that could take place. That's what could cause a 50% bear market in U.S. equities. That's a very difficult thing to price just because it's so connected to cross-border trade and flows. And it just is very challenging. If you want to know more about that, go to the macro report section on my Substack and go to the reports that I published, I think end of last year on the storm is coming and how I'm thinking about that specific factor. Brad Setzer has some great things on that as well. Can you elaborate and quantify what it would mean FX traded on Hyperliquid? It just means that you can trade Euro USD with whatever that carry is, with almost the same amount of leverage access as you could get on prime brokerage. If that happens, you will have hundreds of billions of dollars flow into Hyperliquid, hundreds of billions, because if you have FX, the most like large liquid market, leverage market, get comparable leverage exposure so that you pay for margin with the same price that you would pay on a brokerage account, game over. All right.
And by the way, right now they do have Euro USD and USD JPY on there.
Totally.
Not terribly much. There is, I don't know, $8 and $10 million of volume. So it's all coming there.
Yeah, it's happening. I mean, it's just going to happen. All right. Final question. In a similar vein of robotics, real-world assets, and derivatives, do you take the idea of deliverable compute features and related instruments seriously? If I understand the question correctly, it's just the entire idea of liquid trading markets around compute and hardware instruments, if I'm understanding that correctly, whether it's the compute itself or GPUs or the hardware, whatever it might be. So I'm not going to say that I'm an expert on this. I think there's people that are on wherever else. I think Citrini has a really good guy that talks about that a lot. Here's what I will say is that once you have any type of market where you need liquidity, I just think that people are more likely to list on Hyperliquid than they are anywhere else now, because you can just list it right away. You don't have to go through this entire process of, oh, do we need to talk to the CME? Do we need to talk to the New York Stock Exchange? Do those guys like us? Do you know, like all of this stuff that creates barriers in the industry just from relationships. And now you can just move right away, and it's just going to go so fast people don't even understand. So am I bullish Hyperliquid? Yes. I don't typically, if you've been following me since the beginning, you know that I don't typically just come out and say like, hey, I'm all in on this. Doesn't really happen a ton. This is, something that I see as pretty world shaking and disruptive. And my biggest bet on that is the Hyperliquid Strategies company that is, in my view, the best exposure of that because of its edge in the market right now. And I think the fact that we're up 18% of the day when Hype is up 12 and, the ETF is up 11 is a perfect example of this. So, my entire goal is every single stream that we do, every single report that we put out, all comes back down to this. How do we map the macro regime, which is what we're doing today? And then how do we take asymmetric bets within that? And that's about Hyperliquid, Oracle, things like that per. And every single thing that we do, it'll be laid out on the Substack. You can get everything, all the updates there, and all the proprietary research is on the Substack as well. If you are not a subscriber on the Substack, just for free, go through you can do a 7-day free trial. You can do whatever you want. Go to the website and start going through the models, spend time investing. I always tell people, you don't even have to become a paid subscriber right away. Just become a free subscriber and start investing in yourself. I'm always going to challenge you and push you to figure out what the best lane that you should be in and how do you bet on yourself more. Because at the end of the day, your biggest limiting factor is you investing in yourself. You are the biggest limiting factor in your life. And once you begin to recognize that and take agency and improve, that's when the real change is going to come. And so, I'm going to lay out all the informational side and stacking those macro edges. And then James is going to continue to lay out how those factors connect to the larger macro regime. James, final thoughts.
No, I think that was a good wrap up. 2 hours. So, wow.
2 hours.
I hope you guys like the new layout here. I think it's much improved. And a lot of good questions today.
James made that. That's why James made that. So that's why.
Well, let's be honest. Our boy Claude made it.
It's true. James, like I hope you guys like the thing that I made. So
yeah, I'm trying to button it up here.
I like it. It's all the little touches. So hey guys, tag me online wherever you guys are doing stuff. You can tag James as well. If you guys have anything that you're working through, just come in the comment section on Twitter or tag me. Substack chat is open. You can always put stuff there. I'll be laying out the entire slide deck from today as well. And with that, I will catch you guys later.